Welcome again, everyone, to another installment of our quarterly webinar. We've got plenty of topics to cover. I'm sure most folks are following in the energy markets, and certainly as we approach the summertime, things get even more volatile, uncertain, and a lot of questions still remain on how these markets are going to perform over the rest of the second half here of the year. So we'll get started. I'm Neil Hendricks, joined by my grizzled industry experts, Matt Hobson, Andy Kyle. Thank you, gentlemen, for today, for being here today. And I want to give a shout out, take a moment to thank the team bringing this together from Energy Edge. Chris, Glenn, Hostia, Ethan, thank you for your assistance in putting all this on. Takes a team to pull it off. So I don't know if you guys watched the finish of the PGA Championship. I don't know if you had time this weekend.
Yeah.
I bring this up because we've got to keep our streak going where we talk sports ball at the top of every presentation. But
no doubt. Yeah.
Stay with me on this. The course, I felt like obviously was very challenging. Even the name to me is challenging to say. I don't think I can pronounce it correctly, but just the way the greens were set up. Aronimink.
They just called it the Mink.
The Mink. Okay. That's easier. Got to keep it simple for guys like me. So, any PGA major course is going to be tough. This one felt like with the greens, the elevation, the changes, the valleys, the trenches, ridges, and all that, it just felt like it was even more so. And the commentators kept talking about even the littlest, smallest deviation from, the fairway to the green was going to wind up with, major consequences and detrimental results. And we saw that with higher scores, obviously. And it was a tough test for even the best world players. And I just kind of liken that to, today's energy market. I'm making a link here. Stay with me.
Yeah.
There's a lot of trenches, a lot of valleys, a lot of peaks, uncertainty. You throw weather on top of any, golf round or energy, season. It's going to have its influences. So I'm going to say that, Energy Edge will be the caddy for the audience today. We'll try to help you navigate, this uncertain season, and bring, all the little twists and turns that are certainly impacting and influencing markets today. So, and then additionally to I don't know much about the winner, Aaron Rai, but he's the only thing that I know is he wears two gloves, which is considered unorthodox or untraditional approach, and it feels like buyers have to sort of take that view as well, that sort of the traditional ways of how we monitored and bought energy are certainly changing, and so we might have to incorporate some new methods and new strategies to address that. So all right, a little bit of admin time. Obviously this session will be recorded. We will make the event viewable after the meeting. You should get a link following the conclusion for the video and the materials. We also save these now to our YouTube page, which you can find on our website, energyedge.com. You can go there to follow links and follow our weekly blog as well. If you have any questions during the session, please, we'd like this to be interactive. We want to hear from the audience. There is a Q&A button. If you just select that and type your question, then we will work to address it during the session. All right, so let's get on the first tee, fellas. What do you say?
Well, when I think about my golf game, I definitely feel grizzled. That's for sure.
yeah, beaten.
Andy can attest to that. He's played that golf with me. He's seen it.
Yeah, I don't know if I like being thrown in with the word grizzled, but okay.
It's meant to be a compliment. It's meant to be a compliment
to
your experience. All right, so I think to kick it off, we've got certainly our usual topics. Let me find my screen here. Covering off all the major ISOs. I think obviously top of mind with a lot of the headlines are centered around some global conflicts. What's going on in Iran is certainly having an impact to energy markets. So we'll talk about that. We'll lead off with that. We've got an expanded natural gas section today. We're going to cover some more regional aspects and address a lot of what's going on in the various gas regions as well. And then, like I said, we'll cover off the major ISOs as we typically do. So I think, Matt, you're up to talk about global conflicts. Maybe this isn't quite having the impact, or is having a very degree of impact of what's happening on natural gas, which is leading us to talk, because that influences electricity for sure.
Yeah, no question. Well, certainly if anyone joining us is in Europe or is in Asia, they're feeling the impacts of it certainly a lot more than we are here in the US at the moment, at least with respect to natural gas and power markets. Big story obviously with the conflict is the impacts it's having to the crude oil markets and to the refined products markets. We're certainly all seeing that, whether you're in the US or you're in other parts of the world, at the pump and in feedstock prices and in a variety of different areas. And let's maybe talk globally about natural gas first. Definitely seeing impacts there. To put it into perspective, about 20% of global LNG supplies flow through the Strait of Hormuz on a daily basis. That transit route has largely been closed since the conflict started back, late February, early March of this year. That has had a meaningful impact on global natural gas prices. You can see from the graphic, JKM, which is sort of the marker or the benchmark for prices in Asia, TTF, which is sort of the European benchmark. Both of those markets have really taken off. Order of magnitude, initially at least, nearly a double, maybe even a little bit over double increase in near-term prices. And this is kind of looking at 12-month strips on a go-forward basis. It's settled down a little bit, as you can see, as markets have kind of adjusted, but still remains quite elevated compared to where it was prior to the beginning of the conflict. Zooming in more here to the US, you really can hardly even see, partly because the sort of frame of magnitude is so much bigger for natural gas prices in Europe and Asia, even prior to the conflict. But you really don't see much impact to natural gas prices here in the US at all. We've got both NYMEX and Houston Ship Channel captured here, and those really haven't moved very much. In fact, Fern, if anything, was a bigger sort of market mover, and even that, markets have sort of settled in since that event happened. Much the same story on the power side. You don't really see major impacts from the conflict, even with the slight increase in gas prices. Really more the dynamics that we'll talk more about today that are impacting power domestically is kind of the big thing that's going on. So I think in terms of bullish indicators, bearish indicators, on the bullish side, the LNG issue is definitely one that has the potential to have some psychological impacts if this kind of continues on, right? At some point, you would expect there to be some bleed over into the US markets from what's happening in the global markets if this continues for a while. 20% of global LNG supplies is certainly a big amount. The other thing, maybe from a longer term perspective, there has been damage to a lot of energy infrastructure in the Middle East because of the conflict, military strikes on both sides. The Ras Laffan LNG export facility, I believe, is about a 5 BCF per day overall export facility. So really, really significant. And I think there's potential there that facility, at least partially, could be offline for a meaningful amount of time in order to repair that damage. So again, maybe in the near term, we're seeing no impacts, but from a medium to longer term perspective, things like that definitely have the potential to put upward pressure on prices. On the flip side, though, from a bearish perspective, we haven't seen it yet, but there's certainly been a lot of talk and a lot of concern about any potential sort of global economic slowdown as a result of much higher energy prices, again, particularly in other parts of the world versus the US. To the extent that happens and you see demand destruction, in general, we could see some easing of U.S. natural gas prices. The other thing that we definitely are watching closely, and I think has probably had the biggest impact so far, is there's a lot of incentive now to produce more crude oil domestically, obviously with global crude oil prices much higher. So that will lead to more associated gas coming to the market, and that has the potential to sort of push more gas into the domestic market and potentially put some downward pressure on prices. So all in all, I think our view is, from a near-term perspective, not really any major impacts. Medium to longer term really depends on kind of how things play out. If the strait stays closed, if it takes a while to repair production assets there and export assets there, and also what it does in terms of the longer-term LNG export development here in the U.S. If we see even more growth than what we're already expecting that certainly has the potential to impact prices here. But again, already utilizing all of the capacity to export LNG here in the U.S., so just not seeing much of an impact in the near term.
Matt, would we have expected prices to go the other way if we didn't have such a large LNG export capacity here in the U.S.?
Yeah, it's a good question. I think, potentially, right? I mean, that what we saw in the Ukraine-Russia situation was much more impact to U.S. gas prices, right? And that was, at that time, we probably had, 7 BCF a day less capacity than we have now. We were probably in the 10 to 12 range, give or take. So saw some pretty major implications from that event. So, fast forward to today, yeah, a lot more capacity and just not seeing as much of the impacts as what we saw back then.
Yeah. Makes sense.
Yeah, for sure. So to dig further deeper into the topic of gas, and like I said, we've expanded this section to include some regional views as well. So, Andy, you want to kind of give us the overall view first, and then we can dive further into the regional stuff.
Yeah, for sure. As Matt mentioned, you can see on this blue line for what's the hashed line is BAL 2026. You can see the spike here would have been Winter Storm Fern, and then the secondary significantly lower spike would have been the beginning of the Iran conflict. Overall, the Iran conflict in general has had a downward impact on natural gas in the near term. We'll get into the regional stuff here in a minute, but certainly the additional production from crude has supported additional associated natural gas, which has pushed that price point down a little bit. But all in all, nationally, natural gas is a good point, good price point right now. But as I mentioned, significant regional differences we'll get into here in a minute. This is directly associated with what we just spoke about, us being a net exporter of natural gas now, and it being a net importer of crude. So as we've had to ramp up crude production, we've also ramped up natural gas production, which has gone different directions in terms of price, which is kind of an interesting juxtaposition, but it's one of the benefits of being a net exporter of natural gas at this point in time. From a pricing perspective, we've seen 2026 has been quite significant so far on BAL 2026 deliveries. 2027, has softened quite a bit from really Q4 2025, down close to like 50 cents off, which is certainly a result of some of the conflict going on in Iran and more natural gas being produced. And then, looking at longer dated deliveries, 29, 30, 31, all those are kind of holding flat really as we see more LNG export coming online, using up, any kind of excess capacity we have right now. So a lot going on in the natural gas market, depending on what calendar year you're looking at delivery for. But certainly some, relatively speaking, attractive prices versus some historical opportunities, even a year ago. So something to keep an eye on if you're short gas positions right now to maybe take a look at some of the stuff in 27, particularly BAL 26 and maybe even to 28.
Yeah, absolutely.
From a supply and demand perspective, very, very strong, I would say on both sides. Once again, associated gas has really flooded the Permian, particularly, really due to lack of pipeline capacity to really move the excess natural gas that's being produced associated with crude to the east, where it needs to go for LNG export, resulting in negative $2 spot prices right now in much of the Permian region, and even sub $2 spot prices, everything west of the Texas Panhandle. So if you look at Colorado, California, New Mexico, any of those hubs right now are basically right around $2 or even lower because of all the excess natural gas that's sitting out in the Permian and has no way to go east. However, on the demand side, we're seeing continuous strong demand. We're at the last 14 months have all been at or near record highs from a demand perspective when you total in all exports, pipeline capacity, as well as consumption of natural gas. So no letting up on the pedal in terms of natural gas required day in and day out here in the U.S. Don't expect that to change given the data center build out and the expansion of electrification while we can get, renewables built faster, there's still a need to have baseload generation, which is effectively natural gas in this country at this point in time. So, something we're keeping an eye on, but I would not expect either supply or demand to falter in the coming months as we move, further and further towards a more electrified grid here in the U.S.
Yeah, and
Yeah, and
I mean, no,
Go
go
ahead,
ahead,
Tony.
Matt.
Now, as I say, maybe it's worth pointing out, you think about, we talk a lot about, and we will more in the, when we go through the power markets, the growth in natural gas generation. It's going to take time, right? There's a lot of backlog. There's long lead times to get turbines and other equipment. That said, the existing gas generation fleet across the U.S. probably operates at about a 40% capacity factor, maybe 45%, right? You've got some units that tend to operate around the clock, but you've got a lot of peaking capacity, a lot of intermediate capacity. As demand grows for power, all of that's going to just operate more, which means more
100%.
demand for gas. And that
Yeah.
comes quick, can come quick.
Yeah, no, I was just going to point out that it feels like these two are, sort of working in tandem, and a tip in one or the other could lead, if you get a drop in demand, then does production pull back? If you pull back production for whatever reason, there's a consideration we might hit a glut in storage later this year. Does that curtail demand because prices see a spike? It just feels like it's a seesaw that's perfectly balanced right now, but could go one way or the other.
Yeah, there could be some concerns around supply if we continue to see negative in-basin pricing. If we continue to see negative $2 in the Permian, eventually someone's going to turn the spigot off.
Right.
And we're starting to see a little bit of that, but not to any kind of materiality at this point in time. So on the production side, that'd be the one thing I would keep an eye on. Demand wise, I mean, when you include LNG exports, I don't think demand's going down. So take that for what it's
true.
worth.
Sure,
Yeah.
for sure. So then turning to storage and kind of the view of how things, especially coming out of that quick winter we had with the Winter Storm Fern.
Yeah, speaking of balancing, so storage is the key to making sure that the tightness of our supply and demand picture is maintainable and sustainable long term. So we had quite a bit of concern coming out of Winter Storm Fern. We dipped below the 5-year average there, and we're pretty close to the bottom of the 5-year range there. However, we've had very good storage rebound associated with really some of the Iran conflict supporting that excess natural gas production coming out of certain basins, and we're currently 140 BCF above the 5-year average and 51 BCF above this time last year. We have an expectation for a 96 BCF injection on the report tomorrow for week ending May 14th, which if it comes in a little stronger, that could be our first triple-digit injection of the year, which would be fairly early for a triple-digit injection. We have seen some in May before, but typically not the first half of May. Regionally, we've got Pacific, Mountain, and South Central all above 50% of their total capacity. Once again, you look at where those are regionally located, it has to do some with the excess natural gas that's being produced. The other three, which are the much more sizable capacity storage locations, are not quite at that same level, but are all still on par or slightly better than where they have been historically from a regional perspective. So we're in good shape across the board from a natural gas storage perspective, given the capacity we do have available. Not to say we couldn't use more capacity, but for what's available, we are utilizing it and are in good shape going into, a strong injection season, most likely this summer.
Yeah, for sure. The return felt really quick, and I guess we can attribute that to milder weather and that strong production.
That's right.
Definitely milder weather for sure.
Yeah.
So from an LNG perspective, we talk about this as being, both an opportunity and a concern on the supply demand picture. Right now we're averaging about 16 BCF a day. We hit almost 17 or almost 18 BCF back in March. Expectations are that's going to effectively double to 29, almost 30 BCF by the end of 2029, early 30. Most of that is going to be in the U.S. You can see the all the blue color on here is all U.S. based LNG exports. The more majority of which sit somewhere in the Texas and Louisiana coasts. Mexico also has some small pieces, and then obviously Canada in the orange. All in all, we've got about another. Do some quick math. Almost four. I mean, almost 3 BCF coming online for the balance of 2026, and then you've got another that are expected to reach FID, later this year. That are targeting maybe late 2026, early 27 expansions as well. But we're on a path very quickly to doubling this export capacity, which is going to need more pipeline capacity to be able to make that happen. Without expanded pipeline capacity, I would expect that you're going to see increasing natural gas basis east of Louisiana and decreasing natural gas basis west of the Panhandle. So it could be interesting as we see geographical changes moving forward, but pipeline capacity is going to be key to making all of this work and not having significant price diversity across our land here. All in all, though, I mean, I think these are going to be moving forward very quickly. The current administration has expedited a lot of this type of approval since coming in a couple of years ago, and all these things are pretty much on full tilt to get built as soon as possible.
Yeah, and I think maybe worth mentioning, I think where we sit today, most of the capacity, the new LNG export capacity that's expected online this year, I believe is largely on at this point. So I think we're kind of in a period now where you've got Golden Pass partially now on, Corpus Christi's additional facilities, Plaquemine. I think LNG Canada may be in the commissioning process. So I think we're kind of moving into a period here, sort of through the balance of the year, where we may not see any major new step change in export capacity. Really, it'll be next year where we'll begin to see that next big step change up with some of these new facilities.
Yep.
Yeah, and there's still the debate too of domestic versus export, and given circumstances, certainly in the winter, if we are tight in reserves for winter, do we still keep exporting? I know those are some concerns for some of our larger industrials, but more to come on that, I'm sure.
For sure.
So moving to the regional view.
Yeah, it's a good segue from Andy on this, and I think he said it really well in terms of kind of the dynamics that we're seeing in the regional market. So the views that you see here are forwards at a number of different hubs in kind of the Texas and Gulf Coast region. And I think you can think about the story here being one of, the closer you are to the production basins, to the Permian, to the Eagle Ford, to the Delaware, the lower the prices are going to be. The closer you move to what's really becoming kind of the giant sink on the Gulf Coast for LNG, those prices move up. In fact, to that end, Henry Hub itself has been one of the highest sort of price markets going on now, the last several months, which, historically was not always the case for sure. But you can see Houston Ship Channel, trading at a pretty meaningful discount to Henry Hub. But the big story being, Waha, El Paso Permian, all of the markets that are sort of production markets in the Permian and the Delaware, major discount, even negative for the balance of this year because of all of the things we've talked about, right? That growth in production, sort of stranded gas because there's not enough takeaway capacity. Definitely new pipeline capacity coming on over the next several years, and we have seen some added in the past few years. But the amount of demand growth, to move that gas to the coast and to other consuming areas is just continuing to sort of lag behind because of that ability to move that gas to market. So I think we expect that to continue. The thing we don't capture here, but Andy did mention it, if you continue moving further east, right? So you start in the Permian, low prices there where the production's happening. You move to sort of the Gulf Coast, higher prices where we're seeing that gas move overseas. If you keep moving further east, markets in the Southeast are actually trading at a pretty meaningful premium to Henry Hub because of all of that gas that historically maybe would have made it to those consumption markets, but now is leaving via LNG to go overseas. So that's something we're also continuing to watch pretty closely. Then let's see, moving to the middle part of the country, the Midwest and the Mid-Continent. Similar story in terms of, you look at markets like Oklahoma, ONEOK, to a degree, NGPL, Texas, Oklahoma, those markets, more producing markets, definitely seeing prices trade at a relative discount to where NYMEX is, particularly in the near term. Longer term, maybe a little bit different story. But you move to more consuming markets and certainly more winter-driven markets, Chicago Citygate, Mishcon Citygate, those markets are going to continue to trade. We're seeing them at a discount to NYMEX, but the winter premiums definitely keep the forwards higher, right? So you look at balance of this year, not really having a lot of peak winter left in it, but when you look at, Cal 27, 28, 29, those are still trading at a, relatively stronger level compared to what you're seeing for other markets. And I think also seeing some benefits, we talk about the production versus consumption relationship. We'll see on the next slide or on a couple slides from now, we talk about the West markets, strong production in the Rockies. That's definitely helping keep the Chicago Citygate and the Mishcon Citygate relatively lower, as well as production out of the Marcellus. But again, Marcellus production, similar to Permian, constraints around pipeline capacity and ability to get that gas to some of these markets. So then moving to the Northeast, definitely a different story here. Certainly a very winter-driven market, always challenging when you look at the Algonquin Citygate market. That's one that, and I should have said this when we talked about the Iran situation, even though the U.S., generally speaking, is not an importer of LNG, that the New England market definitely does sometimes import LNG in peak winter season. So that's something that, we'll need to watch pretty closely as we head into next winter in New England. To the extent there's still major impacts to the global LNG market, that could start to filter into what you see in the Algonquin market. And that's probably explains some of the volatility in the forwards for 2027, right? So watching that pretty closely, but also good to note, just order of magnitude on these charts, much, much higher overall level of prices than everything else that we've talked about. And again, that reflects sort of the winter risk, the scarcity premium that gets built into the forwards and out of Winter Storm Fern. Certainly a lot of these markets saw spot prices trading up in the 80, 90, 100, in some cases $140 an MMBTU. So, near term, you can see in the forwards, not a lot of concern balance of this year. But as we get into next winter, definitely elevated levels. And I think from a physical, spot perspective, definitely risk of those scarcity events happening again as we have, major winter storms. And then last, moving to the West Coast. Interesting here that you see, kind of the trend in the other markets was generally as you move further out in time, and kind of the trading history has been prices have been, generally moving up or at least remaining flat. Different story on the West Coast. All of the California markets, SoCal Border, SoCal Citygate, PG&E Citygate, have seen some meaningful declines in forward prices over the last, call it 6, 7, 8 months. A number of reasons for that. I mean, you've definitely had some pipeline issues that have led to higher prices in the past that have gotten resolved. Some storage issues that are in a better position now, as Andy highlighted when we were talking about storage levels, definitely looking very good from a West Coast storage perspective right now. And again, that production story, right? Growing production in the Rockies markets that is ultimately flowing to some of these West Coast markets. You can see for CIG Rockies, that's a market that definitely much more tied to production and relatively low from a balance of this year perspective. But even, beyond that, trading at a relative discount to where NYMEX is trading currently. So right now, the outlook for the West Coast looks pretty good from a gas perspective. We'll kind of see where things go from here. So Andy touched on, oh, go ahead, sorry.
No, segue. Go ahead.
Yeah. Andy touched on this earlier, but from a storage perspective, this is something that we've been concerned about certainly for a while. I think in terms of LNG demand growth, in terms of just sort of the overall demand picture growing, but really not having added storage capacity, which is really sort of the buffer to get us through the seasons where we're producing less gas than what we're consuming, and to get into periods where we're producing more gas than what we're consuming. So we have started to see some expansion in storage, some new projects announced that are in development in various stages. A lot of it's centered around the Gulf Coast, as you can see from this list, largely to support LNG exports and support sort of the major consuming markets that you have there. What I think is interesting is as we begin to see, we talked about this earlier, more demand for gas for power generation, that won't be confined to the Gulf Coast, right? I mean, we're going to see that in PJM, we're going to see that in MISO. So to the extent that you continue to see growth in demand in those markets, likely you're going to see the same need for storage capacity there to kind of balance through the winter. And obviously those are even, bigger winter markets for sure. So I think this is again, good to see some improvement in the picture here, but I think this is an area that we'll be continuing to watch pretty closely.
And my quick math is, excluding the up to 96, this is what, like about 5% increase?
Yeah, about 200 BCF out of 4,000 today.
So-
That's right.
Yeah, so sizable, but just the tip of the
Yeah.
iceberg, unfortunately. Yeah.
Yeah, no question. Yeah, and you put it into perspective, right? I mean, the amount of storage capacity that we have today for roughly 4 TCF or 4,000 BCF, it's a relatively small percentage of the overall sort of consumption picture. And it's becoming an even smaller percentage, right, as demand grows. So that really highlights the need for additional capacity to kind of make sure that we can balance out through those really peak events.
Yep. Makes sense.
Yeah. And yet another market influencer, right? It's not just injection withdrawal season, but also what's our capacity for storage too. So
Yeah,
the
absolutely.
problem continues to get multifaceted. All right, so
Yeah.
moving into electricity markets, but first, obviously, we're going to end the week with Memorial Day weekend. That's a signal that summer's coming, and certainly on the minds of power buyers, gas buyers. What's the summer prediction? What's our forecast? What's the data tell us so far?
Well, I'm pretty sure you guys are all experiencing heat wherever you are at this point in time in the US. Maybe unless you're out in West Texas, but for the most part, yeah, the next couple of weeks are going to be pretty warm. I know it's really hot here in Orlando at this point in time, but looking at the precipitation side of it, that's a big improvement. Getting some rain, particularly across the ERCOT region, and then most of CERC or the southeast would be a very, very necessary, very needed, I guess, thing right now because we have been in a drought for quite some time in most of those regions. A little lower expectations across the Northeast and the Pacific Northwest, unfortunately, for the next couple of weeks. Looking longer term, oh wait, the heat persists. Shocking. So it's gonna it's gonna be warm. I mean, it is the U.S. and it's summertime, but most of that heat looks like it's gonna be, sitting in the West, Pacific Northwest, even potentially, which is kind of interesting, and then the northern part of the southeastern areas. I don't really know how to describe that. Southern Appalachia, something like that. And then fairly mild maybe across the upper Midwest and the Great Lakes region. From a long-term rain perspective, a little bit limited there. Not a lot of expectations for anything major in terms of rain, though. I'm glad to see that we're going to catch up here in Florida because we've been behind on rainfall all year long. So, all in all, though, pretty normal expectations for how we see the summer for the last, call it 5 to 10 years, really, across the U.S. It's been warmer than expected, on a 30-year norm basis. And then we just to see how extreme it actually is when it gets there. But I don't think there's anything too concerning at this point in time, but just something to keep an eye on as we move towards the summer period.
Yeah, all that rain in Texas, that's not going to help if you want me to try to improve my golf game.
Yeah.
It is. I mean, the next week and a half, it looks like it's going to rain every day. It's crazy.
Well, maybe that break will let the exercise some of the demons, eh?
There you go.
Maybe.
And then, as I mentioned a second ago, drought has been pretty extreme. Texas has this nice white pocket here, which is unusual for Central Texas, maybe North Texas. But yeah, it's been very, very dry in other regions, particularly in the Southeast and then across the plains and the West. If you are a skier and went out west a little bit to try to get some ski this year, it wasn't a great experience for the most part, and they're now seeing that from lack of hydro production going toward California, but also just lack of overall water in the ground in the plains and in the Rocky Mountain region. So not
California
a great
overall doesn't look too bad, surprisingly. I would have thought it would be worse.
California's not bad.
Levels.
Yeah, California's probably better than we have seen it. Obviously, we'll see how much snowpack they actually get coming off of the Sierra Nevadas. But this region in the in the dark red right in the middle of Colorado is pretty concerning from my perspective. It's not a normal view for Colorado to have that much drought this early in the year. So
For sure.
certainly going to exacerbate any kind of heat we get and cause more problems for power plants and drive prices up if we get any kind of extreme heat, particularly in Texas or across the SPP region. Anything approaching 100 degrees is going to exacerbate pretty quickly.
Yeah, absolutely. So looking ahead to ERCOT, what's our review currently?
Yeah, so ERCOT's probably been, one of the the most bearish actually over the last couple of months. We've seen 11% reduction in North Hub 2027, one of the biggest declines across any of the markets. A lot of this is the fact that we had a strong, successful handling of Winter Storm Fern. Really no repeat of the Uri catastrophe, even though we had a 78 gigawatt peak. Um, Fortunately, we've added about 40 gigawatts of capacity since 2021. Most of that being, solar, but also some thermal as well. That's really helping to drive down the winter risk premiums that have been sitting in the curve for quite some time now. Jan Feb strips fell about $2, even though we saw gas go up about 3% over the same corresponding period. And then this is completely different than what we've seen in PJM and MISO, which Matt will talk about here in a second, where we saw winter premiums go the other direction. RTCB, or real-time optimization with battery storage or batteries, has been pretty much a step change in market efficiency. We've estimated they're going to save about $2 billion annually for end users. We'll see if that actually shows up, but certainly have seen that in forward offers for ancillary services, as well as in just the efficiencies in which we're seeing ancillaries dispatched. Not so great for those that are providing demand response and LR, but certainly seeing a tightening in the risk premiums that are associated with ancillary services now that you can basically handle those in both day ahead and true them up in real time without some sort of kind of augmented auction that can be expensive for those people who are that short. On the supply side, the battery fleet is up to about 14 gigawatts now. 6 gigawatts were added in 2025 alone. We're at almost 30 gigawatts of solar as of 2025, and more coming online in the next, well, they'll be closing that off in about 10 days, but we've had quite a bit added since then as well. Batteries are on the evening peak now, adding about 4 gigawatts at about 8 p.m. And then, which is really helping to support, wind and the thermal assets that are backfilling as solar starts to ramp out that period of time. We have seen battery applications fall though, mainly because the revenue source for batteries has gotten crushed as volatility has kind of gotten driven out of the market in recent years. That's going to put a damper on opportunities in the near future, which will ramp back up volatility and prices, which will reinstitute people putting batteries back into the queue again. So it's a cycle we all watch every couple of years, but unfortunately that's where we are. On the Texas Energy Fund, the $7.2 billion gas plant loan program, we've only got 2 of the 100 plus projects approved for about $321 million. The others have not really moved forward, too much, but there are 18 projects totaling about 7 gigawatts that are now in the full interconnection studies. But really not a whole lot in terms of hitting the timelines or expectations that the program put out there. Hopefully the other assets do come online, because if you look at the ERCOT forecast, we do need that generation. But at this point in time, it's very much delayed. On the demand side, the large load queue has tripled from 63 gigawatts to 232, and I think it was over that, like 370 something the other day.
Yeah, I think 410 is the latest number. Yeah,
really?
It's unbelievable.
I can't keep track. It moves too fast for me.
Yeah. Yeah. It's like my golf score, much the same.
The one thing I will say is that that's probably not realistic. If you look at what ERCOT has out there from a peak demand perspective, they have not released the capacity demand reserve report, which I'm not sure they're actually going to get out this year. Looking at last year, I think summer 26 was like a 90, and summer 2032 was like 100 I don't know, 15 or 118
Yeah.
peak demand, that's well off of 400. So don't think that all that's going to come online, but it is certainly, driving a bullish nature and certainly signaling that we need more generation in ERCOT to meet that increasing demand.
Yeah, maybe worth noting though, I mean, I think all of the analysis that we've done and we've heard from market participants, you probably need energy prices in the, let's say, $65 to $80 a megawatt hour range to really support new build gas generation at the current economics, which we know the cost of building gas generation has gone up significantly in the last few years. But nonetheless, that's kind of the reality that that everyone's got in the back of their mind.
Yeah, and we're nowhere near that. I mean,
We're not.
2031's at 55 and change, and it's the highest priced of all of them right now. So,
Yeah.
not a lot of incentive for people to actually build it from an economic perspective, but certainly from a expected demand view. You going through some of these charts real quick. Obviously, you can see storage or solar just compounding year over year in terms of its ability to supply load. Wind's been pretty stable, a little up this year versus year to date last year. Coal, on the other hand, trickling off a little bit. Natural gas trickling off a little bit. You don't really see battery storage on here because it doesn't really supply load, but it's certainly a big portion of this other category, which isn't really showing up there. But all in all, ERCOT's in fairly good shape with the exception of maybe 2 to 3 hours June through August and maybe a day or two in the winter when it just gets, bracingly cold. But the hours of risk are being compressed to a very short amount of time, but they are very, very risky when they do occur. So think about that in your procurement strategies. LMP otherwise, pretty nominal. I mean, we got a little above 40 in JM because of Winter Storm Fern, but otherwise we've been very attractive for quite some time in ERCOT. All right, looking at, so I don't know if you guys know what capture prices are, but basically capture prices are the resulting revenue achieved by an asset class. So in this particular case, we're speaking about solar and wind capture prices. So whatever hours that wind is generating, you take that as a percentage of how it's of the alt around the clock type price. So just kind of give you an example in that August of 23, where you see that big spike in the orange, that solar captured 200 and, call that $70-ish, whereas the average LMP was only $200 because the solar hours were worth more than the 7x24 on that one day or that month. While wind captured, significantly less than the average because it was during the overnight hours more so than during the daytime hours. Looking at this from a trend perspective, you can see that solar on the dotted orange line is definitely a downward trend. Not really capturing 100% of the around the clock price very often, and certainly not over the last couple of years, really. Whereas wind is much more in line with the 100% line there at the middle and capturing pretty close to the average LMP on the round the clock basis. Net, I think that trend is going to continue as we put more and more solar on. The generation is just strong during the middle of the day, which drives prices down, which results in a lower capture price, but effectively pushes other generation into other hours of the day, i.e. you've seen a duck curve most likely. That's going to continue to happen. Battery storage will help, solve some of that. Doesn't change the ultimate capture price for solar necessarily, but it does help, solve the problem of moving excess solar into more needed hours of the day.
Yep, that's a good picture too, and I don't expect. I mean, the LMPs, the flat bars here, it just tells us that we've had pretty good luck with summers the last 2 years. I wouldn't bet on a third time. Feels like stretching our luck a little bit, but maybe I'm not a meteorologist.
I don't know. It's a lot more solar generation coming to the market for sure.
That's for sure. So switching gears into PJM, challenged obviously with the same type of topics, load growth, but also you throw in the capacity market and a facet that's centered around regulatory action as well. So a lot to talk about in PJM.
Yeah, I think here, kind of in contrast to ERCOT, a market that certainly was hit a lot harder by Winter Storm Fern. And I think you've seen some of the impacts of that. In the graph you can see from a forward market perspective, the trend has really been up, in contrast to ERCOT here over the last 3, 4, 5 months. I think that's, largely adding in more winter risk premium. And again, the overarching, sort of concern about demand growth and what that ultimately does to prices. You can also see it in the spot prices, right? January, February, really, really high spot prices relative to what we've seen over the last 3 years. That has since settled out, but continuing to settle out at a level that is above, the same months in prior years compared to where we've been. You can see it definitely in terms of the fuel mix and just the overall higher level of demand that we saw sort of the beginning of this year, largely because of that sustained cold that we saw up in the Northeast and the Midwest. What was kind of a, call it 2, 3, 4 day event for a lot of the country. In the PJM markets, we saw impacts go on for really a couple weeks, and in some cases even a little bit longer than that. So definitely have seen some firming in prices in sort of the forward markets. You don't see it here in the chart because we're just highlighting East Hub, but there has been certainly divergence, between the Northern Illinois market and some of the more constrained East Coast markets in terms of those forward prices. And we expect that to probably continue. On the capacity market side of the equation, we did get some clarity on the extension of the price collar, so that will be in place through the next couple of capacity auctions. So I believe it's the 28, 29, and 29, 30 planning year auctions. We'll continue to see that price collar in place. And I think our expectation and most market participants view that prices will probably continue to clear, if not at the cap, certainly close to the cap going out through that period of time. We're continuing to follow kind of FERC's decision-making around co-location rules. A lot of challenges there that still need to be worked through. And then this is really around, new large load facilities locating with existing generation resources. A lot of focus on acquisitions in the PJM market, right? You've got the Talen Energy Capital acquisition, but also now just as of Monday, right, the NextEra Dominion tie-up that's now going to be a major point of focus. NextEra is interesting in that obviously they're a player that is both a major regulated utility player, but also has significant competitive merchant generation assets. Certainly PJM, they have a decent footprint there, largely wind and solar assets. Dominion, on the other hand, almost exclusively a regulated utility, but both very connected to, the growth in data center markets. Dominion certainly serving that Northern Virginia market. So early to tell, but, it will be interesting to see how that plays out in terms of the approval process, any potential divestitures that come out of that, and any market impacts that we see from all of that activity.
For sure.
Yeah, that's an effort of NextEra to maintain about 50% of their revenue from regulated activities as opposed to the growth in their generation business and renewable development opportunities, right?
Yeah, I think so. And certainly that tells a story too, right? I mean, in terms of where they think the growth will be, maybe being balanced somewhat between the regulated side of the industry and the deregulated side.
Yep. Makes sense.
Yeah, so from a capture price perspective, building off of what Andy talked about with the ERCOT market, different story in PJM. And if you think back to the fuel mix graphic that we shared earlier, obviously wind and solar are a much smaller portion of the overall supply picture in PJM. And you certainly see that reflected in the capture prices, right? So from a wind perspective, relatively steady, kind of running at right around 100%, tracking pretty closely to around the clock prices. Solar, on the other hand, given that we're sort of early in the solar build out in the PJM market, given all the challenges that they had around the interconnection queue, you're seeing those prices actually meaningfully outperform the straight averages of LNP. You're seeing in the summer months when you kind of get peak production and the peak pricing tends to line up really well with solar production currently in this market. You're seeing solar capturing 130, 140% on average of what the simple average price is. So pretty strong. We would expect this to decline as you sort of get more solar coming to the system, and probably begin to look somewhat more like ERCOT, where in the peak summer months it does reasonably well. Winter and shoulder seasons maybe not quite as much so. But it'll all be about how fast that growth in solar generation comes.
And then we've got
So-
a backstop some reliability procurement as
Yeah.
well.
Yeah, and I'll just say, just looking at this slide, it's a perfect example of how independent system operators can come up with more acronyms than I think would be humanly possible. But we almost need a glossary just for this slide.
Yeah,
Yeah,
absolutely.
so the reliability backstop procurement, that this we could probably spend an entire webinar or maybe even longer than that, just unpacking all of the things that are going on with regards to this issue. So to zoom out a little bit, PJM, obviously we've seen it in the regular capacity auctions, trying to figure out how to deal with this major shortfall in generation resources that's coming with all of the load growth. So the idea of the reliability backstop procurement is to, in essence, try to bring new resources to the system through facilitated long-term capacity commitments. So ultimately, the target right now is to bring 15 gigawatts of new generation capacity or new just capacity to the market in one form or another through this initial effort. It's intended to be a one-time mechanism, and then ultimately things will flow back to the regular planning reserve auctions. But unknown how exactly this is going to play out. And I think really in terms of the actual details of it, there's still a fair amount of unknown at this point. But what's intended as of now would be a two-phase process. So phase one would in essence be sort of facilitated bilateral matchmaking with counterparties, so new large loads and developers of generation resources. That's supposed to happen kind of end of this year and into next year. Once that's complete, to the extent there's still, not enough capacity that's been procured, which I think a lot of folks think will probably be the case, it will move to a more central procurement. So where PJM basically will conduct something that will look sort of like an RPM, but for longer terms, and for, sort of more specified resources. So a couple of key pieces here. This is going to be limited, obviously, to new resources, with the goal being bringing new facilities to the system. The selection of those resources will be based on a couple of things. One, obviously, how far along in development the generation projects are, right? So they're going to need to show site control, have some degree of financing, taken care of, permitting, and have the ability to achieve COD by, I believe it's June of 2031. So things that can be done in the relatively near term. I think the thing that we're kind of watching the most closely is, well, a couple of things. One, where do these prices clear? But maybe more importantly, two, to the extent that there's obviously sort of backstop mechanism in terms of the EDCs, the utilities being sort of the ultimate counterparties on this phase two. What happens if there's added costs that don't get absorbed by new load? So that's something that's important for market participants to watch, for loads to watch, certainly. And that's obviously been a big theme for this year and the last year too, right? It's making sure that the sort of impacts of all of this load growth are ultimately borne in a reasonable and sort of fairly allocated way. So a lot that will be coming in the coming months coming out of this process, but want to kind of have it on everyone's radar as something we'll be following.
Yeah, for sure. All right, next up we talk MISO.
Yeah, so a lot of the same themes here to what we're seeing in PJM for sure. So recently had the results of the 26-27 capacity auction. Prices actually came down a little bit compared to where they were last year, particularly in the summer. As you can see there, about a 36% decline compared to what we saw for capacity prices last summer. So that's positive. I think, the outlook overall there continues to be colored by load growth expectations and how quickly generation resources can be built to sort of meet that load growth. In contrast to PJM, MISO is a largely vertically integrated utility market, whereas PJM, a lot of the markets there are deregulated. So I think there is a little bit of an element of, utilities through their long-term resource planning, they're able to kind of respond maybe more quickly or more affirmatively around this load growth. So that's probably helpful. But you can see from a price perspective, similar to PJM, I think coming out of Winter Storm Fern, definitely seeing winter risk premiums increase in these forward prices. You saw a lot of the same impacts in the spot markets. Obviously, that has been coming off, much like PJM, March, April, May, not as bad from a spot market perspective. But in terms of fuel mix here, I think, and you'll see this in the capture prices in a second, the growth in solar generation in MISO has been more meaningful in the last couple of years. We've seen more projects coming online. I think that's probably going to accelerate. MISO kind of went through similar challenges as PJM with the interconnection queue, but have largely worked through that, whereas PJM's really just kind of getting back started with accepting new applications. So I think we'll see growth in solar pretty meaningfully over the next several years, and then kind of see once the tax credits expire where that goes. So yeah, from a capture price perspective, MISO, again, having a little bit more growth in solar, you see this sort of pattern where you're seeing lower highs in the summers, right? And you're seeing lower lows in the winters. And that's indicative of a market that is seeing growth in solar, right? As you add more of that resource type to the system, very similar production profile, no matter where you are in the MISO region, you're going to see some impacts in terms of somewhat deteriorating capture prices. We've seen that in ERCOT. You'll definitely see it here in a second when we talk about the CAISO market for sure. From a wind perspective, that's a generation base in MISO that's been relatively stable. I think we're seeing some development of wind, but not nearly as much as solar. So I think the thing to watch here is as you continue to see more solar resources coming to the system, probably expect to see some degradation in those capture prices.
Yeah. So last but not least, CAISO. I can't believe I'm saying this, but it's like the lowest priced market currently on forwards. It's kind of a
energy price, right?
Yeah, energy. Yeah.
We don't want to talk about all those other costs, right?
All the other regulatory overlays, but from a pure power perspective, it is definitely the lowest price, which is quite opposite of this time, last year or even later into late 24. California did not experience the same issues that the other three major ISOs experienced during Fern. Mainly, they didn't have the cold to the same extremes, but they also had a very strong storage surplus, which helped them, kind of wade through that without any kind of major concerns. As I mentioned earlier, from a gas production perspective, the western part of the U.S. is really seeing a boon in lower prices there. That has moved PG&E Citygate, down 25% year to date for about 2026, while the rest of the other gas hubs out there are also moving down in a similar direction. From a power forwards perspective, NP15 is averaged about, not power forwards, from a day ahead perspective, power's traded around $35 per megawatt hour in January and 31 in Feb. Very low LMPs overall, SP15 even lower than NP15, down about 27 to 29% below last year's levels. From a forwards perspective, they've traded down for 27 and 28, really based on that additional storage, but also just the demand has been limited out in California. You haven't seen the demand growth that you've have in other ISOs as well. We're a little concerned about the snowpack. I think I mentioned this earlier, but with the lighter snow season, snowpack's down about 75%. So hydro could be a little bit limited this year. And with the $1,000 per megawatt hour cap being removed by FERC, any kind of tightness in some of those solar ramp out hours or low wind hours could become challenging in different times of the year, particularly as we move into the summer. Looking at a fuel mix, the interesting things here is, the gas is continually being compressed as they move toward a higher state of sustainability in California. They are currently, I think they hit 67% last year in 2025, not on an hourly basis, but annually. And the goal is to get to 60% on an hourly basis by 2030, and then to 90% sustainable. So emissions free by 2030, 90% emissions free. But look at the imports as well. So if you see the imports looking at 2022, they dropped down dramatically in 23, 24, and they've kind of started increasing back up to offset for that natural gas. Wind and solar have been pretty much, very similar the last couple of years, with solar being basically double what the wind production is. And we'll get to that on the next slide and talk about the capture prices. But all in all, LMP has been very low in CAISO for some time, and particularly in 2026. And, expectations are that's going to continue barring some material event this summer with heat and lack of hydro. So from a capture price perspective, CAISO is obviously the farthest along in renewable, development. And so that is meaningfully impactful for solar. They don't have about half as much capacity, maybe a little less than half capacity of wind versus solar, but from a generation perspective, wind is about half of what solar generates each year. And you can see that the solar is obviously significantly impacted during the summer periods when its generation is exceeding the actual demand on the grid. Hence the number of batteries that sit in CAISO now and then are continuing to be deployed, into the future, helping to kind of offset some of this, as you see, moving from 24 to 25 to where we are in 26 right now. They certainly improved from the 24 timeframe, but solar capture prices are not good relative to the around the clock average, whereas wind is almost exactly right on the around the clock average because it has a good mix of overnight, but also meeting some of that ramp out hour period and really helping to bolster wind prices and stay at the ATC. All in all, CAISO is gonna continue to see a trend like this until battery storage reaches a deployment level that allows it to basically move all the excess solar into later periods of the day. With long duration storage coming, that is certainly on the horizon soon, though. That's all I got.
Wow. Yeah, all good stuff, gentlemen. Appreciate the time. We're a little bit over. That's okay. No questions right now, but certainly if you have questions following this event, please feel free to reach out. Like I said, the recording will be available as we wrap up here. You'll get a link to that. But if you don't, or if you want to follow up more on these discussions, please feel free to reach out. Thanks again for your time, gentlemen. I hope everyone, and thanks for everyone for attending, and I hope everyone has a good rest of the week, and we will see you next time.